everyone, welcome back to Upside Down Data. Today I want to talk a little bit about what the heck happened yesterday with the CPI print and why didn't markets tank like they did last time when the CPI came out in June. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. We put a lot of updates, better indicators, and more over there. So if you've been following the macro markets, you're probably aware of this narrative of inflation being really what has been causing these big drawdowns in markets. Bitcoin has not been spared. Really that narrative really kicked into full gear sometime around November of last year. And, Bitcoin was one of the first assets to really shift into that narrative, really start falling off, and then stocks followed not too soon after. So people in the crypto space have been watching the CPI prints very closely because, if you get a favorable CPI print, one that would be going down, that is seen as bullish. You see ones that go to the upside, especially ones that surprise to the upside, that's generally seen as being bearish. And so what we saw back in June, you see I have these two dates here identified, June 10th and then now July 13th. These are the June 10th was when the May CPI came out. And then yesterday, July 13th, was when the June CPI came out. And what I want to draw people's attention to here is the reactions of the market after both of these. So if you've been following the market, you know that when the May CPI came out, it surprised to the upside. It was quite a bit higher than an expectation. So basically, May showed greater inflation. There was greater inflation in May than the market expected. And what we saw after that was this huge collapse in Bitcoin, right? We saw a price fall, from the open of that day to the absolute bottom there, 41, almost 42% to the downside. A bloodbath of pretty epic proportions. Anyone who was around paying attention to the market then, definitely felt that pain. And so then going into this CPI print yesterday on July 13th, I think a lot of people were expecting the same. That if we got another bad CPI print, one that surprised to the upside, we'd see a big crash. And we did get a surprise to the upside. The consensus expectation was 8.8% CPI in June. We actually got 9.1%. So we surprised to the upside in a pretty notable way. But what was interesting about yesterday, about how the markets reacted, is look how different this reaction is from here. We traded up on the day. We actually rallied 4.76%, and we actually continued that rally a little bit today. So overall, the rally is up about almost 7%. We did have an immediate kind of drop to the downside, but it quickly got reversed back up. A very different signature than we saw back here. Now, that this doesn't mean that Bitcoin can't just collapse and do this again later. We don't know. But at least so far, the market reaction has been very different to the one back in June. So let's talk a little bit about why that might be. So first, I just want to show that Bitcoin's not the only one that's acted a little bit, differently to this CPI print than the June one. I want to go look at some of the major stock market indices and show how they reacted. So again, in June, we saw this major drop off where the market started heading down a little bit before, probably some kind of advanced indications of the CPI and people kind of pricing it in, and then we really crashed. So, but from the open going down to the bottom, the S&P 500 was down about 8.3%. Look at the NASDAQ, it's a very similar story. That from the opening of the day where the CPI was announced to kind of the bottom, the local bottom, 8.46%. And the Dow Jones showed the exact type of pattern, dropping down about 7.56% from those. But if we look at what they've been doing more recently, now they're not quite reacting like crypto did. They're not actually really rallying back to the upside, but they're not really tanking, right? You're not seeing this gapping down like we saw after the CPI or the May CPI print came out back in June. We're actually seeing the markets relatively kind of holding their own. The NASDAQ actually closed a little bit up today. Dow Jones is down a little bit, and the S&P 500 is down a bit. But we're not seeing this big tanking in the price. So why is this? What is going on? Well, one thing that's important to look at is that the situation right now is different to the one that we were in back in June. And I think a good place to look is some factors that feed into CPI, specifically commodity prices. This is what a lot of people have been looking at. So if I go over and look at the oil chart, for example, this is the crude oil chart. We can see that, back on June 10th, which would be right around here, oil looked like it was just going back up to the upside. It was basically at its local top up here. It was just marching back up, and very much looked like it could go on another explosive move to the upside. And you actually had a lot of market participants, calling for oil to quickly rally up to crazy levels, crazy high levels, coming off of that. And so there was no indication back here that oil prices were cooling off at all. And of course, gas prices being extremely elevated, at least in much of the world, especially, in the United States, relative to what's usual, that's certainly something that was feeding into inflation, right? Let's look at another commodity. Let's look at lumber. Lumber back in, lumber is a little bit different back in June, but it was starting to rise, move back up to the upside. It's now kind of been rejected, moving back down. Copper, back in June 10th, was still kind of more or less looked like it might be moving for another push back to the upside. Look at wheat futures. They were still roughly kind of elevated, back around here, not quite at their highs, but coming down a little bit. And I think we can see it most clearly if we just look at an index of commodities. So this is the GSG, the GSCI commodity index. And this basically just indexes a bunch of different commodities so we can get a more kind of overview of the commodities market. And you see that the June CPI, the May CPI came out in June right around the peak, right? Basically right at the peak of commodities as a broader group. And so for any kind of market participant looking at these charts, there wasn't any indication that this part of the CPI, this inflationary pressure of commodity prices rising, there was no indication yet that this was really cooling off. And really what we saw is in this last month, just this massive move to the downside. So for this index, it's down, currently around 17%, a max down of almost 20%. So commodity prices have really fallen off a cliff in the last month. And of course, if commodity prices fall, that also then should take some of the pressure off of inflation. It should be a deflationary pressure. Rising commodity prices is inflationary, decreasing commodity prices is deflationary. So when people saw this surprise to the upside in the CPI, in some ways it was, it was beyond what we expected, but it was also taken into different contexts, because now we know that at least some elements of what's feeding into inflation are reversing, or at least look like they might be reversing. And so the expectation is likely that then when the CPI print comes out for July next month, it's probably going to be lower than it was for June, because we've already seen some of these inflationary forces start to fall off. Some potential early indications of moving back to the downside. So that's one possible reason why the market reacted so differently yesterday to how it did back in June. In June, we look at commodities, they were very much still showing very much an inflationary story. Now they're showing a more of a deflationary story. So the context is different. Now, the second thing that's important to look at is how the bond market reacted, because this actually gives us some other indications about what people might be looking at. So let's look at the 2-year yield. So again, came out yesterday, and you actually saw the two-year, this is the 13th. You saw the 2-year start to rally on the inflationary news, which is what you'd expect, right? The inflation, not rally. There's a sell-off. There's a rally in yields. The yield and buying and selling are inversely related. So if you see yields going up on a bond, that means that people are selling that bond. So 2 years, people were selling out of the 2-year, and that's what you'd generally expect, because usually when you get higher inflation prints, you expect the Fed to raise interest rates more. Therefore, that's generally a time where you're selling bonds. You're waiting to buy in at a higher interest rate to get better yield. What's interesting is that the 10-year, so a longer-term Treasury, actually did the opposite. Here, people were actually buying 10-year Treasury bonds on this surprise upper bound inflation number. And that's weird, right? You'd expect that people would just be selling bonds and the yield would be rising on that kind of a news. That's what happened before. If we look back here, June 10th, look at this explosion in the 10-year yield that followed off of that May CPI print, right? About a 15% shoot up in the yields, breaking past the local top here, an acceleration in bond yields. People were selling out of the 10-year, again, expecting higher interest rates. But they didn't do that yesterday. Now, they did trade up a little. There was a little bit of selling that happened today, but yesterday, people were largely buying the 10-year. And what this is diagnostic of, and we can also see this if we just compare the yields, is that the bond market is getting worried about a recession. That's the way that a lot of people interpret this type of behavior, and I think it's a reasonable way to look at it. And really what we've seen recently is some yield curves starting to invert, and so the two I just showed you have inverted. The 10 and the 2 have inverted. And a yield curve inversion basically means that in normal circumstances, kind of in normal economic conditions, you should see that the short-term bonds will have lower yield than the long-term bonds. And the reason for this is that if you're buying something more long-term, you're kind of necessarily taking on more risk. So therefore, you expect a greater return for that. And so it should be the case that shorter duration bonds have lower yield than longer duration bonds. But occasionally, you'll see that flip, like it has right now. The 2 years at 3.13 around about percent. 10 years at 2.96 roundabout percent. And so if you just look at them, just subtract the yields from each other, we can see that now the 10-year yield is now below that of the 2-year yield. That's what I'm just showing you here. I'm showing you the 10-year yield minus the 2-year. So when it goes into negative territory, that means the 2-year yield has gotten to a higher yield than the 10-year. And this tends to happen before recessions. You saw it in 2000, you saw it in 2006, 2007, and you also saw it back in 2019 before, ultimately led into the March 2020 crash, kind of a short-term recession there. And now we're seeing a pretty deep inversion of the 10-2 yield curve as well at the same levels we saw back for the great financial crisis. And so, the reason why this happens is that, when a recession is becoming more and more likely, people are basically not optimistic about the short-term outlook of the economy. So therefore, locking up your money for a little bit longer and securing some higher amount of yield while interest rates are high is a little more attractive. And so it kind of breaks the normal dynamics of the bond market. And again, it's because people expect the economy to not do well soon. They expect a recession to be oncoming. And so really what the market is probably doing right now, what we're probably seeing, is that the market is kind of stuck between two different things that it's trying to figure out. On the one hand, there's inflation, and the Fed then kind of chasing the CPI with its financial tightening, with raising interest rates and reducing its balance sheet, which is not good for risk assets in general. That's what we've been seeing ever since basically November. But on the flip side, then you also have the market trying to price in a possible recession that's coming up, and that is a very much a different type of environment. That is very much a deflationary environment, and that's a case where the normal dynamics that have been playing out for the last few months about how the market responds to inflation will start to go a bit of a different way, because then the market's going to start expecting the Fed to pivot, for them to ease off on the interest rate hikes, and for them to ease off of the reduction of balance sheet, and then eventually pivot back to quantitative easing. And then one of the things I think the market is trying to figure out is how much is already priced in the market in terms of an oncoming recession, right? When you've already seen, valuations in the stock market drop so drastically, I think the question is, how severe is this recession going to be? How much are earnings going to fall off because of this recession? And then, do stocks need to be revalued based on that potential drop in earnings, or has most of that already been priced in? Because the stock market tends to recover before the bottom of the actual kind of recession, right? The stock market will start moving back to the upside before economic conditions actually recover. Basically, the market's forward-looking. It can anticipate kind of the bottom, and it basically front runs when that bottom is. So that would be the question here, that if the market were to start rallying from here, it's possible that market participants feel like any kind of recession we're about to go into has already been priced in, and therefore people are then going to start putting their money back into risk assets, or especially start buying bonds and things like that, again, expecting interest rates to start falling. We don't really know, and so I'm not going to make any strong predictions about whether or not this is the bottom of the stock market. If we don't have another leg down. Same with Bitcoin. I'm not going to predict if this is the bottom or if we have another leg down. But the dynamics in the market are starting to turn, right? From a very much inflation dominated completely narrative all throughout this nasty drawdown we've been in, we're now starting to switch to a different narrative to some degree, and we can see it starting to form in the markets, where now the fear of recession is starting to creep in and starting to affect how market participants are engaging with the markets. So we don't really know what's going to happen, right? And frankly, obviously we don't even know if we're going to go into recession, although, I think some argue we're already in a recession. But I do think that it's useful insight to have, useful context to understand why the market reacted differently. Because back here, there's the expectation that the inflation story was just going to keep going, that there was no peak in inflation coming, and that the Fed was just going to tighten. Now we have a bit of a different story where maybe peak inflation is in sight, and the Fed is then, in a not too incredibly distant future, going to have to start putting on the handbrake because they don't want to dive us into a super deep recession. And then that will bring in all new dynamics, that'll turn back on quantitative easing types of those are of course financial conditions that risk assets tend to like. Bitcoin, stock market, quantitative easing, paradigm is much more desirable than a tightening paradigm. And so we could be starting to see a change in the tide. Now, does that mean then that Bitcoin's just going to go ripping back to the upside? No, not at all, right? I think, what's very much possible is that we're just going to have, if we are really at the end, well, I'm not going to call it the end, but if it were close to the end of kind of the inflation narrative, we started switching to the recession narrative, it would really depend a little bit on how much the correlation with the stock market keeps up. Because again, if earnings tank, the stock market could go down with them. And then if Bitcoin remains heavily correlated to stocks, it could get dragged along for the ride. We don't know if earnings hold up a little bit better and the stock market kind of chops sideways for a bit. Maybe Bitcoin does the same thing. We don't really know exactly what's going to happen. But my base case is that kind of in the better case scenario, and the more plausible best case scenario, that Bitcoin just starts consolidating down here, like what we've seen towards kind of these bottoms of previous bear markets, right? Where maybe the absolute low isn't quite in yet for Bitcoin. Maybe like we're somewhere around here and the new low will happen, but then it's not going to get much worse from that. That's kind of what I see as the more plausible kind of good case scenario. Now, obviously, the best case scenario is that we just go ripping back to the upside. Personally, don't see that as all that plausible. But I also don't think that we just have to go crashing down to some crazy low level either, if, again, the macro story actually is changing. Because, that's one of those things is that, you don't want to be caught stuck in the old narrative. And so we want to keep an eye on these data, get a sense of when the narrative is changing, and then when it is, reevaluate our position on the market. So, again, I don't pretend to know exactly what's going to happen. But I do just want to point this out so that you can keep an eye on this for yourself. Keep an eye on these dynamics between inflation and recession and how the market reacts and how the Fed reacts. Because that'll probably tell us a lot about what is going to happen to risk assets and crypto going forward. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. Put a lot of updates, better indicators, and more over there.